I get a very common question of how much money do I need to start options selling? And you know what? There is a lot of misconceptions about how much you actually need, because for me, someone who sells a lot of cash secured puts an emphasis on the cash secured part. This means that I have the money in my account to actually support my trades. I'm not selling what we refer to as naked calls or puts. This essentially means you are using leverage to actually make your trades, and I am not a fan of leverage at all. So in this video, I want to give you guys a few examples of some cheaper stocks, something like SoFi that's trading around $17, along with taking an example such as Meta, say, that's trading around $600. So we're going to look at a few examples, some cheap, some expensive, and then I'm going to show you guys how much you actually need to start. So a few things I want to point out here is for how many trades I'm making in any given week. Let's say I'm making 5 trades for the week, and what I'm going to do is I want you guys to pay close attention to these little headlines I have here. So we have communication, technology, consumer discretion, consumer staple, healthcare, etc., etc. What I want you guys to do is go and do your own due diligence and find companies that you like and you want to add to your watch list. And I want you to split them like this, because first of all, before we even get into how much money you need to start, there's one thing you guys need to understand, and that is obviously diversification. So if I'm making 5 trades in any given week, what I'm usually doing is I'm popping over to my symbols list right here, and then I'm picking, all right, let's put one in from consumer discretion as my first one. Obviously, I'm going to have some technology. I'm going to have some maybe healthcare. We can go down, say, all right, well, financials look good this week, so I'll put some in financials. And then maybe energy is looking very appetizing. So now I have 5 stocks in 5 different sectors. And why do I do this specifically? This is because just as you would have a regular portfolio of stocks that you own, you don't want all of these eggs in one basket. If you have 5 stocks all in the same sector, and this entire sector decides to take a hit, all these stocks are going down with you. In a case like this, where you have different sectors and you're more diversified into different industries, this one can be tanking and this one can be catching a bid. This one could just be staying the same. And this kind of rotates. As we have sector rotation throughout the week, this means, well, one's going up, one might be going down, one's staying the same. The next day comes, this one might be going up, this one might be going down, and this one might be staying the same. And this is the whole concept I want to get across. Before we get into the actual how much money do you require, I want you guys to take into account diversification, because this is very, very important. Because if you have, say, a $2,000 account, let me just do this. Apologies for my slow writing. This is me using a trackpad to record this video. So if you have a $2,000 account, and say we choose something like SoFi. SoFi is trading, let's round this evenly to about $17. Now, in a case like this, with SoFi trading at 17, if you were to sell a put right at market price, so right at $17, this means that you are requiring one contract, say, so times one contract. We all know that one options contract controls 100 shares of the underlying asset. So in a case like this, one contract at $1,700 is actually equal to 1,700. Now, in a case like this means you're tying up almost your entire account in one trade. If you make this trade, you would technically have about $300 left over. So what I want to get at, what I'm trying to get at, I should say, is when you have a smaller account, you're not really able to diversify as you would like to. And for me, every single week, I am diversified completely. Maybe I'll even flash up my current week's trades so you guys can actually see. Excuse me, I have a few different names that I'm running this week, but they're all in different sectors just because I like to stay diversified. Just as your actual portfolio should be diversified, so should your trades. They should not all be in the same sector. So in a case like this, when you have a smaller account, what you need to understand is you are basically tying up your account in a single stock. And that is very, very dangerous. And you know what? If you guys are trying to grow your account, this is kind of the unfortunate case of this until you can have a bigger account size. Like I would say about roughly $20,000 is when you would be, very, very happy to start running like a fully diversified portfolio. So there are a few things you can do. If option selling is something you're very passionate about, you can run something like this. Obviously, this is not financial advice. This is something how I did it though. When I didn't have, a lot of capital to play with because I was just learning, I was selling options, just almost like maxing out the portfolio. Once I got very good at it, then I just bumped the account to about $20,000 to see. I started selling options with this amount of capital roughly. And then this is where I really got used to it. This is where I really understood it. And then once you kind of get past this mark, this is where you can fully do this with whatever amount of capital you have, following a set amount of rules as well. So in a case, like I said, like SoFi, where you have a $17 strike for one options contract, this means you're tying up $1,700 in your portfolio. But again, this is what a cash secured put is for. Because if you were just doing this on margin, then you're essentially making this trade on borrowed money. And you know what? I'm not a fan of using margin at all. I'm actually very upset because on Interactive Brokers, you actually require a margin account to sell options, even though I would rather just do it with the cash in the account. So a big thing here is understanding with a smaller account, you are not really able to diversify a lot. So if you were starting with something like $5,000, let's just write this out and say, like we had a $15 strike price on SoFi. This means you're tying up $1,500 in SoFi. All this means now is one trade is taking up $1,500 out of your $5,000. This means that you will have $3,500 left over for the rest of, if you're selling weekly options, then you have $3,500 left over for the week. So now in a case like this, you're basically looking for something that's trading at $35 or under. So if we used Carnival Cruise Liners, that's trading at about 26, and we sold at a $25 strike. Again, one contract at $25 is going to be one contract, and it's going to be at 100 shares. I should have put that a little bit forward more. Oh my God, I'm so sorry, guys. But this just equals $2,500 is what you're putting up to make this trade. So now, obviously, this is subtracted by this, and now you have $1,000 left over in your account. So now, basically, once you got into the $5,000 mark, you can kind of run two trades, one smaller one bigger one, and you're not very diversified. So this is the whole concept I'm trying to get at here. The diversification aspect is really non-existent until you have a bigger account size. So yes, while you can start with, even $2,000, $2,000 is, where you can kind of start playing with stocks. But again, the entire point of this strategy is running this on stocks that you want to hold for the long term. So realistically, how many stocks are there that you are, wanting to hold for, the next 10 years that is trading at $17 right now? There maybe isn't that many. I sold a put this week on OKLO. This is trading at about $40 right now. So at a strike price of 40, again, multiply that by 100, you just get $4,000. So when you do this, this means that I'm tying up $4,000 in capital to make this one trade. So again, if your portfolio is $5,000, you're tying up basically your entire portfolio with $1,000 to spare in one trade. So this is all I'm trying to get at. There are a lot of companies that are trading, under that $20 mark, but it is a matter of doing your own due diligence and seeing what you actually would like to own long-term if you are assigned, because the whole point of the strategy is we are not scared of assignment. We want to be assigned shares at levels and own those at a discount, paid to make the trade, paid to while we're in the trade, and paid to exit the trade. So again, diversification is so key. So if you are one of those guys that wants to start selling options quickly, again, not financial advice, but if you're starting with a lower amount, just understand that's what you are aiming for. Because in a case like this with SoFi, we'll do this example one more time before I move over. If this is trading at, say, we wanted to do a $15 put with one contract, this means we're tying up $1,500 out of the 2,000. So what we're going to do is we would go to the options chain and check. For rule of thumb, we're just going to say it was a 1% gain on the capital that we put up, which means that we would make, for a $1,500 trade, 1% of 1,500 is obviously $15. So this means you're making $15 in options premium, and you're putting up $1,500. Now, this does not sound like a lot of money. This sounds like, dude, why am I putting up $1,500 just to make $15? But what you have to understand is when your account is small, that is almost a 1% trade. So what you can just do is divide 15 by 2000 and multiply by 100. That is actually 0.75% on your account for the week. So the entire portfolio isn't even put to use. It's just that 1500. That means you're returning 0.75% in 1 week. So multiply that by 4, which is obviously for 4 weeks. So if you ran that for 4 weeks at 0.75%, you are making 3% in a month. And now this is where this gets put into perspective, because the S&P 500 returns on average, and this is very key, on average it returns 10% in a year. This means it can have down years. This means it can have 20% years. It can have negative 30% years, but on average it returns around 10%. So if you just did 3% in 1 month and you ran this back 3 times, 3 months in a row, because by the time you've run this, if you just ran this one trade, and there's obviously a lot of variance, there's sometimes where you can run this a lot better. There's sometimes where you can run this and you're, not making that exact 1%. So while accounting for variance, we'll just, use the 1% rule as reference in this particular case. This means in 3 months, you are generating 9% on your portfolio. Now this looks a lot better when in comparison to this, but it's just because you have that small amount of capital that you don't like it. So what is 1500? We'll check the math on this. So what was it? It was 9%, so 0.09. This means in 3 months you made $135 on your portfolio. While that does not sound like a lot of money to you guys, I completely understand. $135 in 3 months does not sound like a lot of money. And let me tell you, this is amazing. While you guys might not see this as a big deal, you can literally call it quits if you were roughly around that mark. Stop trading for the entire year. But remember, this is 3 months in out of the 12 months. Now, obviously, like I said, you're not going to be returning 1% every single trade or 0.75% every single week. There's obviously going to be variance in this, and I want you guys to understand that. I'm just trying to give you the numbers to show you how much you realistically need to start. But if you were doing that 0.75 per week times 52 weeks, so what, 0.75, obviously multiply that by 50. I'm not going to do by 52. I don't know the exact how many trading weeks there are, but I'm just going to use 50 as like the benchmark here. So 0.75 times 50 is 37.5. That is absolutely absurd. 37.5%. Even knock this down. Let's take 7.5% off the top of that number. Let's say you were averaging, a somewhat around that 0.7% every single week. There's obviously weeks where you have like a 0.4% week. There's weeks where you maybe have a 1% week. And let's just say that you returned 30% on the year. Where do you find returns like this? Genuinely, and this is what I want you guys to understand, 30% a year looks insane. When you're just looking at it from this perspective, 30% a year is absurd. But when you look at it from the perspective of, well, when I started with $2,000, what is 30% of 2,000? So 2,000 times 0.3 is $600. So while this might not look like a lot of money, $600 right here, this doesn't look like a lot, but when you put it into the percent terms, this is what makes this even more insane. And this is what I want to draw your guys' attention to, because while the 30% looks unreal, the $600 does not look good at all. But on 30% of your portfolio, that is phenomenal. And this requires only a few hours of your week. This can be done over the weekend where you're identifying your stocks, you're identifying your levels. There's so many videos I have on my YouTube and my Instagram page of me explaining how the strategy works. You're finding your levels, you're finding your discount, and that's it. You're making money when you're starting the trade, when you're selling a cash secured put. You're making money when you're in the trade if you're assigned by running covered calls, and then you're making money when you exit the trade while obviously selling a call at a level to get your premium and your share gain. So like I said, you guys really need to understand this is a percent game. This is not get rich quick, and I need to get that across to you guys. You have to understand that this is a percent based game, because while 30% does not equate to much on a $2,000 portfolio, if you had a $100,000 portfolio, that's the magic number that everybody strives for. You basically just made a salary for the year with not a lot of work. With these same metrics, this 30% on $2,000 that made you $600, this 30% on 100K is 30K. So look how much faster your portfolio would be growing if you had this much money. Like I said, this is where you start. This is where you want to end up. Because by the time you get to this point, now you're making 30% on 100K. The next year after that, your starting balance is 130K. So now when you go to do 30% of 130K, this is going to equal, I did the math wrong. This means the next year you make $39,000. 40K is like the average starting salary for literally just any job, any like base level entry post-secondary job. So this is what I'm trying to get at. Look how fast this compounds. You started with $2,000. If you could just save your money, invest a good amount, even if you're just investing in the S&P 500, you don't want to actively sell options when you're, at this stage. Once you get to like even a $50,000 portfolio, this is where you see the immense gains. This is where you're making like over $1,000 a month for just a few hours of your week. Well, I will say here that, like I said, this might not look crazy, but as this compounds, it's 30, 39K, and then the next year you're going to be starting with 169,000, and 30% of that is 50,000. So this is how this grows. Basically, let me get rid of this so you guys can actually see it a little bit easier. So like I said, you started with 100K. The year after that, you're starting with 130. The year after that, you're starting with 169,000. So you can see how quickly this starts to grow. So again, this is a big snowball game here. And this is what I really want to try and get across to you guys, because the more capital you have, the more stuff you unlock, the more stocks that you unlock where you're saying, hey, like these bigger names are looking a little more appetizing now because you can afford to have them. And my biggest rule of thumb is if I have 10 trades per week, so 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And assume that all 10 of these trades were feeding and made up 100% of the portfolio. So 100%. This means each of these trades is equal to 10%. And I live by this rule of thumb for my personal account, because my personal account is obviously at the point where I live off this. Now I just make content for you guys to try and teach you about this. No position in any given week equals more than 10%. Obviously, there is a little bit of variance here. I've been doing this for a long time, so I can kind of push that boundary a little bit. But for rule of thumb, 10 to 15% is that point where you should say the stock should not equal more than that in the account. Because if you have one stock that is 50% of your portfolio and that one stock takes a dive, you are going to be freaking out if you're not used to trading this strategy. And overall, if you just had a portfolio and one of your stocks dove, 50%. So the biggest thing here is obviously understanding your capital allocation. Like I said, with small accounts, this is where this really gets you, because if you dive 50% on a $2,000 portfolio, you're literally down to $1,000. So this is why starting with a smaller portfolio can be very, very scary. But as your portfolio gets bigger and bigger and bigger, you start to find that you have a lot more room to play this strategy properly. So in a case like this with SoFi, I think it's a good example to show you guys, there are starting points, there are stocks, that you can trade at this level. Once you kind of get to the point where, like I said, about $30,000, when you have that in an account, you're unlocking basically everything. You have like HPE, you got IREN, FCX maybe a little bit too expensive. Dow is a great, one personally that I like selling puts on. Barrick Mining, you kind of up how much you're actually able to sell puts on. What's it called? Carnival Cruise Liners trading at 26, Celsius at 28, DraftKings at 24. You start unlocking more and more options for stocks. But then I want to turn your attention to the big boys, because Meta trading at $600. Don't mind our swing trades in the position we're building in Meta over here. But in a case like this, so the same logic applies. One put, so let's say we take Meta trading at 600 currently. We're at 597, but we'll just say 600 for the example. Times one contract of Meta is equal to 100 shares. One contract is 100 shares. You guys have to remember that. So 600 times basically 100 shares or one contract. You require $60,000 in capital to make this trade. So in a case like SoFi that was trading at $17, times one contract, you require $1,700. So this is the difference, because this is the same as this. All we're changing here is the stock. That's the only thing we're changing. Everything else stays the same. One contract still controls 100 shares of the underlying asset. The only thing we've changed is the stock, because that obviously changes the price. So in a case like this, where if you wanted to sell something on Meta, and this could only equate to 10% of your portfolio, you need roughly $600,000 in your account to make this work with a set plan, with proper risk management, yada, yada, yada. So this is why I want to show you guys different examples of this, because, as your capital increases, everything does stay the same. You just have this variance of what stocks you can play. Google, obviously, we don't have to do this example, write it out anymore. At this point, like $326 per share, you need $32,600 to trade this. Amazon, $231 a share, you need $23,100 to sell a put at market price. Same thing, and no matter what stock you pick, you can, I think it's ASML. Yeah, trading at $1,631 per share. So one contract of this is basically just adding 2 zeros for the 100. You need $163,100 to make this trade. And that is with obviously no margin. And I'm not a fan of margin at all. I never use margin personally. This defeats the whole purpose of cash secured puts to me personally. But anyway, so my whole point is, this is where you can get creative. So if you go back to SoFi, and like I said, if you did say a $15 put, you need $1,500. Let me just write that out. But say you had a $30,000 portfolio. This means the $1,500 that you're putting up for one contract equates to about 5% of the portfolio. But this is where it gets cool, because now instead of just selling one put, you can sell, that's supposed to be an X, not a plus sign. Oh my God, hold on. That 15, you can actually multiply by 2. So you can sell 2 contracts. So now all you're doing is doubling the amount, because this now equates to $3,000 that you're putting up. 1,500 times 2, that's it. Literally 1,500 times 2, you get 3,000. And if you had a $30,000 portfolio, this now equates to 10%. So you can still run cheaper stocks. You can just increase the amount of contracts that you're running at a given time for your trade. Now, this gives you the opportunity to obviously still run some names that you like, even if they're cheaper. You just increase your contract size. Obviously, you can't go less than one contract. You can't do 50 shares. The minimum is still 100 shares at minimum to do this with for a cash secured put. Obviously, 100 shares is just equal to one contract. You cannot do, 0.5 contracts and get 50 shares out of this. That doesn't work like that. You're only working in shares of, or in blocks of 100, and your contract sizing is either 1, 2, 3, 4, 5. There's nothing less than 0. But I would urge you guys to go over to the options chain and get an understanding of, some stocks that you like and, how you would be trading those. Specifically, I also encourage you guys to go and make your own watch list and split it by sector, because this makes it so much easier visually, where I can just go, well, I already have something in consumer discretion. I'm kind of missing some financials or energy this week. Let me run that. Let me put that in there. So this makes it a lot easier for me at a given week when I'm selling my options. If you guys found this video helpful, make sure to go leave a like and a comment. Go follow my Instagram as well. We have started popping off on there, so I'm very happy at CYRN. I'm loving all the feedback I've been getting from you guys over there. So if you're watching this and you haven't followed Instagram already, please go do that. We're doing a big giveaway there as well for hitting 100 followers. So if you guys found value in this video, make sure to leave a like and subscribe, and I'll see you guys in the next one.